What if the economy you live in, the economy you work for, the economy you depend on, was never designed to make you free? What if the rules of money, finance, and banking weren't created to help nations grow, but to ensure they never stop owing? Because behind every crisis, every recession, every boom and bust cycle, there is one constant force, a blueprint for economic dependence, built not by chance, but by design, a hidden architecture, a system that rewards endless borrowing, a machine that feeds on debt and grows stronger every time a nation, a business, or a citizen falls deeper into it. Today, we're pulling back the curtain on the banking blueprint engineered to create perpetual economic dependence, and the terrifying truth about how deeply we are all already trapped. To understand the blueprint, we must step back farther than most people ever imagine, because the system didn't begin with Wall Street. It didn't begin with the Federal Reserve. It didn't even begin with modern banking. It began with a question ancient rulers struggled with. How do you control people without using chains? The answer they found was debt, not physical slavery, but economic slavery. From Mesopotamia to Rome, from Venice to London, the most powerful empires understood one truth: if you could control credit, you could control society. But it was only in the last 400 years that this truth was transformed into a global structure, a financial architecture so influential that entire nations now depend on it to function. Key players helped shape this hidden system: the Medici Bank, the Bank of England, the House of Rothschild, J.P. Morgan, the Federal Reserve founders, and later the IMF and World Bank architects each contributed a brick to the same structure, a blueprint where debt equals power and dependence equals control. It began in 1694 with a simple idea that changed the world. A nation could borrow money not from its people, but from a private bank. That bank was the Bank of England. The deal was revolutionary. The government wanted money to fund a war. The bankers offered it at interest. In return, they demanded something profound: a government charter, the right to issue bank, and the power to lend money created from nothing but ink and confidence. This was the first modern blueprint. Create money, gives, lend it to the government, gives, charge interest, gives, repeat. The more the government borrowed, the more the bankers earned, and the more powerful the debt machine became. Other nations watched and copied. By the 1800s, central banks were spreading across Europe. By 1913, the blueprint reached America with the creation of a Federal Reserve. But the blueprint had a weakness: as long as money was tied to gold, debt couldn't grow forever. Which brings us to the next stage of the design. After World War II, the world came together at Bretton Woods. Nations agreed to peg their currencies to the US dollar and the dollar to gold. But the architects of modern finance saw a limitation. Gold couldn't be printed. Gold created discipline. Gold kept governments in check. And a blueprint built on perpetual dependence could not tolerate limits. So the world quietly moved toward a new idea: a fully debt-backed global system. The IMF and World Bank were created, offering loans to nations in exchange for long-term dependence. Central banks began using something called fractional reserve banking, a system that allows banks to lend many times more than they actually have. Suddenly, money wasn't wealth, money was credit. Debt became the engine behind economic growth. The blueprint was taking shape: create money through debt, lend it into existence, charge interests, require more borrowing to sustain the system, repeat forever. The cycle had begun. Everything changed in 1971 when the United States made a decision that permanently sealed the blueprint's fate. Nixon ended the gold standard. From that moment forward, money was backed by nothing but promises, trust, and the debt of governments. It was no longer redeemable for anything real. It became an idea, a product created by banks, expanded through debt, and sustained through endless borrowing. This final step completed the blueprint. A world where money requires debt, and debt requires more debt. No limit, no safeguard, no anchor. And from that moment, global debt exploded. 1971, $2 trillion. 1990, $34 trillion. 2000, $87 trillion. 2020, $255 trillion. 2024, over $300 trillion. The blueprint wasn't just functioning, it was dominating. The consequences were enormous. Governments became addicted to borrowing. Businesses became addicted to credit. People became addicted to loans, mortgages, and lines of credit. Every layer of society was absorbing more debt than ever, feeding the financial institutions at the top. This is the hidden truth. The banking blueprint doesn't grow when you succeed, it grows when you borrow. Every crisis made the system stronger. 1980s Latin American debt crisis, 1997 Asian financial crisis, 2008 global meltdown, 2020 pandemic stimulus, rising national debts. Today, in each case, banks were rescued, governments borrowed more, citizens absorbed the cost. The blueprint was working exactly as designed. Dependence became permanent. Over the years, leaders have tried to escape: cutting spending, raising taxes, stimulus packages, bailouts, austerity, quantitative easing. But all of these fixes attack the symptoms, not the blueprint. The truth is uncomfortable. You cannot fix a system when the system is working exactly as intended. Governments can't stop borrowing because the economy collapses without it. Banks can't stop lending because money disappears without new debt. And citizens can't stop taking loans because prices rise faster than wages. Dependence is no longer a side effect. Dependence is the system. Today, the blueprint is reaching its limit. US debt, $34 trillion. China's hidden regional debt, $10+ trillion. Global corporate debt, $88 trillion. Household debt, record highs. Global GDP can't keep up with global interest payments. We are living through a moment every empire has faced, when the cost of debt becomes greater than the benefit of borrowing. The Roman Empire stretched its tax base to collapse. France printed assignats until its currency died. Weimar Germany drowned in hyperinflation. Argentina repeated the cycle multiple times. When debt grows faster than productivity, the blueprint cracks. And right now, those cracks are appearing everywhere. The banking system is designed to require perpetual debt. Debt is not a flaw, it is the foundation. Economic dependence is engineered, not accidental. Governments, businesses, and individuals all feed the same machine. Every major financial crisis strengthened the blueprint. The pattern is clear. The system rewards collapse, not stability. A warning: every blueprint has an expiration date. A structure built on limitless growth eventually hits a limit, and the global financial system is now dangerously close to it. When dependence becomes too great, the system must reset, either through inflation, default, or redesign. The only question is, who pays the price of the reset?